Hello there, I'm Paula Castro, and today I want to introduce you to the profitability ratios, and we'll be using an example based on the Apple's income statement. Profitability ratios are a class of financial metrics that are used to know businesses' ability to generate earnings relative to its revenue, operating cost, balance sheet assets, or shareholders' equity over time, using data from a specific point in time. Let's start talking about the following concepts. There are some concepts we need to know to understand the whole structure of the profitability ratios. Let's begin with gross profit margin. Well, this one shows us the percent of revenue after subtracting the cost of goods sold involved in production. The cost of goods sold is the amount it costs a company to produce the goods or services that it sells. And how we can see here, there is the gross profit margin of Apple Inc. Okay, now let's talk about the ROAS, or return on sales. This one is a measure of how efficiently a company turns sales into profits. It's only useful when you're comparing companies in the same line of businesses and of roughly the same size. We can see here the example of Apple too, of the return on sales. For this, we need the operating profit, or EBIT. This one takes gross profit and subtracts all overhead, administrative and operational expenses like rent, utilities, payroll, employee benefits, and this one is calculated by analyzing the last section of the income statement and the net earnings of a company after accounting for all expenses. Now, the net profit margin. This one is into consideration the interest and taxes paid by the company. Net profit is calculated by subtracting interests and taxes from operating profit, also known as earnings before interest and taxes, or EBIT, the one I mentioned. And we can calculate this one by dividing net income by net sales. We got here the example by Apple. And we can talk now about ROE. Return on equity is a measure of financial performance calculated by dividing net income by shareholders' equity, because shareholders' equity is equal to a company's assets minus its debt. This one measures how effectively management is using a company's asset to create profits. This one is considered satisfactory. Will depend on what is normal for the industry or company. We got here the example by Apple of return on equity, or ROE. Now let's talk about the ROA. Okay, this one is return on assets. This one is an indicator of how well a company is utilizing its assets by determining how profitable a company is relative to its total assets. This one is the best use when you're comparing similar companies or comparing a company to its previous performance. As a formula, this one is calculated by dividing a company's net income by total assets. And this one takes into account company debt, unlike other metrics such as return on equity, which is ROE. And we got here the example of Apple's industry, and we got the return on assets. And for the final analysis, we got the profitability ratios, we got the gross profit margin, the ROAS, the net profit margin, and the return on equity of Apple Inc. And the return on assets too of Apple Inc. And I hope my talk has been useful and all the concepts have been clear now. And that's it. Thank you so much. Bye.